These macroeconomic charts will blow your mind. First, we're going to talk about what the market is thinking, the prevailing narrative. Then we're going to go deeper into the data, look at what's going on beneath the surface. And then we're going to talk about what to expect next. First up, the prevailing narrative of the market and why it's trading the way it is because the market thinks we've hit peak inflation. This chart is showing gas prices rolling over. And so you have the headline CPI. People are thinking it's about to roll over. Retail gasoline prices expected to roll over. Market thinking inflation has peaked. And that chart comes from Andreas Steno-Larsen. Then you have this chart from Julian Bittel. And you can see New York Fed global supply chain pressure also rolling over. So again, the market starting to sniff out, starting to think that perhaps inflation has peaked. And what does it mean when inflation has peaked? It means the Federal Reserve can finally stop raising interest rates to fight rising inflation and will eventually cut rates. And that is all the market is begging for and craving. And so here is a chart from Macroalph showing what the bond market is pricing in. So in orange, you can see the federal funds rate 18 months ahead versus federal funds 6 months ahead, the difference. So what is happening? Bottom right corner, cuts are priced by February 2023. So the bond market, which is actually the smart money, usually correct, is pricing in Federal Reserve rate cuts in 2023. So the whole market is pivoting from the inflation narrative to the slow growth narrative. And we're out of the inflationary mess into the slow growth mess. And the Federal Reserve can finally start to ease and pump up markets like it's been doing for the last few decades. And so that is the prevailing market narrative. Peak inflation, we're pricing in future Fed rate cuts. And so when was the best time to buy stocks? At the bottom of the 2008 crisis. When was the best time to buy stocks again? At the bottom of the pandemic crisis. So when is the best time to buy stocks? Now, at the bottom of this current crisis caused by Federal Reserve printing and inflation. That is what the market thinks. Now let's dive in, because the crux of this entire narrative is that inflation has peaked. So let's move to the other side of the aisle and see what the inflationists are pointing to, saying that inflation has not peaked and the market is getting ahead of itself. So first up, we have this chart from Tavi Costa showing this price of natural gas, right? So oil, natural gas, the cost of energy is the most important input to inflation. And so if that goes up, then the entire inflation peaking narrative is completely false. So what we had last week was actually a pumping move in natural gas. We are heading into the winter. Europe is in an energy crisis. Most of the world is in an energy crisis. And so this is not a good sign if you are hoping that inflation is going to come down anytime soon. You don't want to see natural gas pumping. You don't want to see oil pumping. And we know that the fundamentals for both of those things to go up in the near and immediate term are strong. This chart blew my mind. Slumping U.S. gasoline stockpiles, fuel inventories in Central Atlantic region are at the lowest level since 2012. And so this is supporting the narrative that the cost of energy is going to go up. And so the bottom line is that there is not as much supply on the market as most would think. There's energy crisis all around the world. This is an indicator of how possibly higher gas prices are here to stay until they can get that supply online. That's what people predicting further inflation are pointing to. They're also pointing to this chart, 12-month change in U.S. consumer prices for rent, shelter, or primary residence costs. This is not stopping. Over the last few weeks, it's continued to pump. Tell me that is not a sign of sticky inflation. Inflation may have peaked, but that is going up. It's really hurting people that are trying to just get by renting. And obviously, we know mortgage costs are also spiking. So that's another signpost that people calling for massive stagflation are pointing to. Here's another one. CPI this comes from Alessio. CPI for mayonnaise, salad dressing, and other oils keeps rising. That is an uptrend. It hasn't dipped like other commodities have. And so just another signpost. Look at this chart. US producer and consumer price gains for food shows no sign of slowing. This comes from Alessio as well. Year-over-year rise, biggest since 1974. So we're seeing some sticky stagflationary issues. Maybe inflation hasn't peaked. Has the Federal Reserve done enough to kill inflation? That's what everyone in the peak inflation camp is thinking. But let's look at this chart. This is showing the federal funds rate in dark blue, the real federal funds rate, versus where it should be to kill inflation. You can see that the federal funds rate in dark blue is way lower than the federal funds rate implied by where it should be according to the Taylor rule. So the Taylor rule speaks to where the federal funds rate should be in order to balance out inflation. Well, right now, guys, it is nowhere near where it belongs. You can see throughout history, it always needs to go where the Taylor rule is implying in order to truly fight inflation. The market, again, thinks we peaked, but this is saying inflation's out of control and the Federal Reserve isn't doing enough. So what if they don't do enough? Well, inflation's going to get absolutely out of control. And so has the market gotten ahead of itself in thinking that inflation has peaked and the Federal Reserve is in control? This chart comes from Macroalph. You can see that the S&P 500 is in blue and it's inverted on top of the US 10-year real rates. So when the S&P 500 goes up in price, the blue line goes down. So what you can see is that it tracks interest rates, the cost of borrowing, very closely. Right now, it's diverged. So the market is pricing in peak inflation. The bond rates are saying something different at this moment. And so this is just recent activity in the last few weeks, potentially a sign. Obviously, this correlation isn't perfect, but that is potentially a sign that the market is getting ahead of itself and thinking that inflation has peaked when real rates are not going down. And so again, the people predicting that inflation hasn't peaked are pointing to the fact that the Federal Reserve has not done enough, but the market is hoping that it has, because what this small rise in interest rates has done was pretty much obliterate the global economy, as we've pointed out. This chart comes from Julian Biddle. Look at US CEO confidence on top of NFIB survey optimism minus planned wage increases. So what you see is the chart of small business optimism in blue on top of US CEO confidence. This is a historic low. The market, the economy is about to fall off a cliff. Look at that confidence. How could your confidence be so much lower than it was in the midst of the lockdowns of the pandemic in 2020 when the entire economy shut down? This is historic pessimism. This is what the small increase in rates the Federal Reserve has done so far is causing. Look at this chart from the Daily Shot. Look at NFIB Survey sales expectations. Small business sales expectations look recessionary. So the economy is collapsing before our very eyes. Here's a fascinating chart from Callum Thomas showing how the New Zealand house market front runs the USA house market, and how generally when New Zealand prices go up or down, the US market follows. I don't know exactly why that is, but what I do know is that rising rates around the world have caused New Zealand prices to crash, and they're about to cause USA prices to crash. It only makes sense for US housing to go down when the cost of owning a house has doubled, if not tripled. Try getting a mortgage right now. Most people cannot afford the new rates. And so the market is hoping the Federal Reserve has done enough, because if they haven't done enough to kill inflation, then we're going to get more bad future looking data. We're already in a recession. It's just going to get worse, and they are going to have to keep hiking. So who do you guys think is right? The peak inflationists or the inflationists who think that inflation has not peaked? My personal opinion is that regardless of whether or not inflation peaked, it's sticky, it's high, and the Federal Reserve has to keep the pressure on. golden rule of investing in essentially a planned economy: sell when the Fed is selling, buy when the Fed is buying. If you had just done that for the last 20 or so years, you would have done extremely well. But right now, the Federal Reserve is selling. There's inflationary pressure. The market may think it's peaked, but if it hasn't, and if it gets worse, then they're going to have to keep hiking. I showed you the chart of the Fed funds rate compared to where it belongs. According to the Taylor rule, it's nowhere close. I've showed you how the data in the economy is bad and getting worse. I've showed you how there is persistently higher sticky inflationary pressure. Natural gas is starting to rise. And so I think the conclusion is that the Federal Reserve cannot take its foot off the gas pedal quite yet. And so the market may be getting ahead of itself. I'm not saying the market is going to crash 50%, but there are rocky waters ahead. Look at how the uninformed retail investors are positioning. In July 2022 into August, that dark blue line on this chart from Jesse Felder is showing an all-time high in tech stock chasing. Retail emotional traders and investors have not slowed down. They are diving into this market. And again, it is very unfortunate, but normally what happens is this group of people goes long at the precisely wrong time, like last time this happened in late 2020 in late 2020. Look at the meme stock assets. Look at how they were chasing meme stocks back in January 21, early 2021. How did that work out? Not very well. And so let's look at this chart, which shows the ARK Innovation ETF, which has been tracking the NASDAQ tech bubble pretty closely. Yes, we've had this bounce in the white line, but is the bottom in? That's not normally how markets work. Normally, it takes some time to bottom. And so given everything we've talked about, given how the US economy is faltering, the global economy is faltering, inflation is sticky. If the Federal Reserve takes its foot off the gas pedal and stops raising rates, that might cause inflation to pick up, which would go against the peak inflationary narrative. So if you've been watching these videos, we've been pretty accurate in the price action predictions based on the information in these charts. I've called for the bear market rally. I think it'll probably continue until the narrative changes that peak inflation is in and the Federal Reserve can start to ease finally, because I think what's probably going to happen is we're going to get rocky waters, rocky price action like this NASDAQ bubble chart is showing. The retail crowds may be chasing at the wrong time, which there's historical precedent for. The bottom line is that this is a very tricky market to maneuver. We have bad fundamental data, but that didn't stop stocks from rallying in 2008 and 2020. But the difference now is that inflation is persistently high. And so whether or not inflation is peaked, it looks like inflation will be stickier and more persistent than the market is currently pricing in. So expect some fireworks. Again, the Federal Reserve is on vacation until September. And so we have some time for this micro bull rally to play out before we get some more volatility. But it's an exciting time. Thank you guys for watching. I hope you enjoy this content. We will continue to stay on top of this market. This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.